Mexico's stock market slipped, and that small move can matter for your portfolio. Here's what a 0.82% drop in the S&P BMV IPC is really telling investors right now. The session was cautious. Traders weighed inflation, interest rates, and fresh earnings signals. Global markets remain sensitive to the Fed's path, so Mexico's moves often echo shifting expectations for growth and discount rates. The IPC tracks 35 large, liquid Mexican names, so swings in a few heavyweights can drive the index. That concentration makes daily moves a useful read on risk appetite and sector rotation. Why does this matter beyond headlines? A weaker day in Mexico's benchmark can influence regional fund flows and how markets price equity and currency risk. It shapes decisions between local shares, American depository receipts, and Mexico-focused ETFs, especially when inflation and policy rates sit front and center. Mexico's central bank targets 3% inflation within a 2% to 4% band. When the rate narrative shifts, equity risk premia and multiples recalibrate quickly. Investors lean toward defensives and strong balance sheets. That's common when growth visibility is cloudy and rates are in flux. ETF users favored broad market exposure over concentrated single-name bets, a sign of wait-and-see positioning. The iShares MSCI Mexico ETF is a common entry point for international investors, but its roughly 0.50% expense ratio is a real cost that compounds over time versus direct holdings. Valuation sensitivity rose across the market. Rate-sensitive sectors tend to see multiple compression when inflation worries flare, while cash-generative companies with pricing power hold up better. For short-horizon strategies, a 0.82% index move is meaningful. Traders often tighten stops, add downside hedges, or rebalance sector weights to manage gap risk. Cross-asset impacts also matter. Currency shifts can either cushion or magnify equity returns, so peso exposure is part of the equation. Here's the practical takeaway. Recheck your Mexico allocation for rate and inflation sensitivity. If you use ETFs, make sure the expense drag fits your holding period and compare broad versus sector tilts. If you own single stocks, watch concentration risk inside the IPC and how a few names can sway overall exposure. Build a simple risk plan. Define drawdown limits, consider basic hedges when volatility rises, and avoid reacting to every headline. Then track the catalysts that matter most: upcoming inflation prints, central bank signals in Mexico and the US, and earnings guidance on margins and pricing power. Want the deeper breakdown and data? Read the full article at finlitica.com.